CEO of MetaliCoin. It's a blockchain-based smart contract system for crowdsourced funding for mining projects. Sounds really interesting. He's actually an AGSM alumni, but he assures me he's never used his MBA, so we're in set hands.
Startup.
We've got Marta Poblet next to Professor Masood, who's the Associate Professor at Graduate School of Business and Law at RMIT. Marta is also a co-founder of the Institute of Law and Tech at the Autonomous University of Barcelona, and her research covers the areas where law, political sciences and technology intersect, so specifically AI, blockchain and human-computer interaction. And last but not least, we've got Patricia Walsh, who's the Digital Associate at McKinsey & Company. She's the author of the McKinsey article, which analyzes the value and feasibility of blockchain across industries. So, very interesting panel, and I'll hand over to Nadia.
Well, thank you. Amazing crowd. Thank you for coming on Saturday morning. We will make your time worthwhile here. So to break the ice, I'm going to ask general questions for those who don't understand blockchain and cryptocurrency market. And I'm going to give the panelists here, we have great panelists here, 2 minutes just to answer this question, and maybe we start with Marta. Can you tell us a bit about yourself and what blockchain technology means to you?
Thanks for having me, first of all. It's a pleasure being here. So, what does blockchain mean to me? I'm approaching technology not just from a legal perspective, but also from a sociological perspective. And at the beginning, in 2008, blockchain was basically, is this?
Don't know.
Yeah. So blockchain, okay, a peer-to-peer electronic cash system. That didn't sound very fascinating to me at that time. So I follow up some of the developments, but as the blockchain has developed and evolved into blockchain 2.0, maybe blockchain 3.0 to mimic the labels of the web. It's clear that it's becoming a very transformational technology, a technology that will create new forms of governance, new forms of politics. And in that regard, I think that every social scientist should be concerned about how the blockchain will develop and what the uses will be. Practically, there will be no domain which will not be impacted by blockchain development. So that's my approach from a social scientist perspective, probably.
Thank you very much. Well, I'm a serial entrepreneur. I've had some fun successes. I've occasionally accidentally been in the not-for-profit space, but that's probably that was Saturday morning. That one took a while. But I actually got headhunted after years in technology to come and help run a small gold refinery in the middle of Melbourne about 4 years ago, and it was 5 years ago now probably, and it was absolutely fascinating. I told them I'm a software guy and this is hardware and I don't know anything about hardware, and they said come and learn. And gold is infinitely fascinating because it has no practical value whatsoever, and I know some of the females in the audience and my wife might disagree with that, but it actually has no practical value whatsoever, and yet it has been the universal means of exchange for all of human history. And in fact, 2,500 years ago in Rome, a gentleman could buy the equivalent of a good suit for about 1 ounce of gold. These days, a half-decent Brioni suit will run you about 1,600 or 1,700 Aussie, which is about, bless you, which is about the price of 1 ounce of gold. So in practical terms, gold has actually not appreciated in buying power in the entirety of human history, but it has been an absolute store of value. Now, why am I talking about gold when we talk about the blockchain? And it's not just because I'm running a startup that's trying to tokenize metals, although that is part of it, because let's face it, you're always marketing. But the reason that it's relevant is because the first generation of blockchain is actually most equivalent, and Bitcoin in particular, is actually most equivalent to me of precious metal, right? It actually has no intrinsic value. It has value because we agree it has value. Hell, is it worth $20,000 as it was at the beginning of January, or $6,500 as it is now, or $1 as it was a couple of years ago? Right? It's only got value because we say it does. It doesn't do anything practical. But it's become a global form of exchange. So in many ways, it is actually analogous to precious metal. And in fact, I've argued to the ATO, to our friends at PricewaterhouseCoopers who are on the ATO reference board, that it should be taxed in the same way as precious metal, i.e. not subject to GST and treated as financial instrument. This is a very long-winded 2 minutes, I apologize. But what blockchain really means to me is the emergence of a new asset class. And when we see new asset classes emerge, we see the generation of extraordinary wealth. And I did forget to do this. It doesn't matter whether you go back to 1602 to the incorporation of the Dutch East Indies Company, which was the first public company in the world. Doesn't matter whether you go forward 70 years in their history when they issued the first corporate bonds. Doesn't matter when you go to the beginning of the derivatives markets and the bonds markets as global changes. When these new asset classes have emerged, you have generated trillions of dollars in new wealth. Make no mistake, cryptocurrency is a new and distinct asset class, and it will generate trillions of dollars of new wealth. I'm not saying MetaliCoin is going to catch all of that, although some of them would be nice, but it will generate trillions of dollars in new wealth. It will disrupt the business models of most of her clients that I'm sure she'll talk about, and it will change the way our economy functions globally. So to me, that's a pretty cool challenge to take on, and I should stop talking. Because I can do it for hours on this stuff.
So a bit about me and what blockchain means to me. So I first came across blockchain when I was working for the UK government. And then Chancellor of the Exchequer, George Osborne, had someone talk about blockchain, and he was like, what is this? We've got to find out about it. And cue hundreds of civil servants trying to investigate the technology. I then was working in a tech startup and helped set up a not-for-profit that has actually now pivoted to use blockchain technology in aid transfer. And most recently, I'm at McKinsey, and I, as mentioned, worked on this report that looked to evaluate the potential impact of blockchain across 14 industries, 93 use cases, and what that means to business. If I think about what blockchain means to me, I think what's really exciting about it is that it can become a technology that substitutes for trust. So if you think about most major institutions, whether a bank or whether government, the real thing they're doing is they're holding records and they're validating transactions. And if you can take out that intermediary or that single person or entity that has that authority and that credibility to say this works, then you fundamentally disrupt everything. And so blockchain technology or distributed ledger technology, really blockchain is just one form of it, is really exciting because it could truly enable proper peer-to-peer models that have a mechanism to be commercially viable.
Good, thank you. Next I will take give turns to each one of you. I'll start with Martha. Again, we want to reflect on our understanding of blockchain and their markets. Martha, in a few sentences, explain to us how blockchain is connected to cryptocurrency, just in simple terms, for the audience to understand the connection between blockchain and cryptocurrency and Bitcoin.
Okay. So, how many people have read the initial paper, 2008 paper by Satoshi Nakamoto? Okay, a few of you. If you look at the paper, the word blockchain doesn't appear, it is not mentioned. It's Bitcoin, electronic, a peer-to-peer electronic cash system, but the word Bitcoin, blockchain doesn't appear. So initially, we're talking about Bitcoin and a way to transact an asset in a public ledger that resolves one important issue, which was the problem of double spending. So many digital coins before that, upon which Satoshi Nakamoto relies on, didn't entirely resolve this issue, and what Nakamoto proposes is a protocol that resolves the double spending issue. So in the next iteration, the protocol, the blockchain, can be used not just to transact this type of assets, cryptocurrencies, but anything that could be tokenized. So that can be represented by a token. Basically, this is in a few sentences.
Perfect. That's perfect. Thank you very much.
If you'll forgive me for being a little bit controversial, my view is that cryptocurrency is the killer app for blockchain. Blockchain as a database is highly inefficient, and I don't think this is a technical forum, but having to have the entire database or hashes, immutable representations of every transaction in lots of points, is actually highly inefficient. And I'm very happy to be disagreed with. I saw you rolling your eyes, and that's fine. But in general, you can do distributed databases in much more technologically efficient ways. So without a tokenization, i.e. IBM Hyperledger, is just a marketing hype. It's bovine excretia, if you'll excuse me. Cryptocurrency is the killer app for blockchain because, and you're going to get sick of me saying this, it's a new asset class. And when you have an asset class that not only solves the double spend problem, which was version 1, blockchain 1, but then allows the rules of exchange to be encoded into the money itself, which is your point about trust, version 2, and then evolves from that to a point where you can get hybrid assets that represent physical world assets, digital rights, rights to property, whether it be income stream, whether it be esoteric things like bandwidth, whether it be practical and physical things like metals. There is no other asset class that is inherently flexible, digital, replicable. So to me, while there are other applications of blockchain without cryptocurrency is to be demonstrated as something useful.
Yeah, well, in their answers, they reflected a bit also about how blockchain evolved. Can you reflect more maybe on that aspect?
Sure. And I don't know that it's helpful, given the number of hands that are up, just to briefly recap and effectively when we talk about blockchain and distributed ledger. Effectively, someone tries to initiate a transaction, whether it's cash or like, does this person own this asset that I think I might provide for them? That information is distributed across, let's say, all of you, and you each have either a copy of the ledger or the record or part of it, and the transaction goes out, you check it, you see when that gets validated. You can use different consensus protocols to then validate that, and if it gets approved, then what happens is that transaction or that I have this asset gets accumulated with a bunch of other records and then logged as a block if you're having a blockchain, and that just becomes part of the permanent record which everybody holds. So that's fundamentally what it is, and so you can apply that technology to data, or you can apply that technology to cash or assets in the case of cryptocurrencies, and that's the distinction. I think Jeremy makes a great point, and that a lot of the places where you see people trying to use blockchain, it's like, well, just digitize your process and just use a database and you get like 80% of the value. But there are other cases. And then I think if you think about the evolution of blockchain, there's a metaphor that can be drawn to the way in which the internet's evolved. And the adoption cycle that you're likely to see, and the way in which you're going to see proof of concepts grow into larger scale deployments, into then eventually mass adoption, is probably going to follow a similar cycle. And I think the World Economic Forum estimates that by 2027, 10% of global GDP is going to be on blockchain or distributed ledgers.
Thank you. That's very
Brenda, something very quickly. Actually, the first blockchain predates Satoshi's paper by 13 years. It was published on the New York Times. I don't know if everybody knows that, but two cryptographers published the first blockchain, not on a distributed ledger, but on a trusted paper, the New York Times.
So, just very quickly in terms of the evolution, I mean, to me, one of the tests of a mature technology is you don't know you're using it, right? Like, who realizes at the moment they're using client-server technology? Right? You all are every day because you're using apps on your mobile phones that are, but nobody knows about it, right? Everyone's talking about blockchain now, and to an extent AI, because they're emerging technologies. And it's not actually a technology set that's either A, properly standardized yet, or B, ready for prime time. So Bitcoin's not bad, because it does one really simple thing, and it does it pretty well, although there's a lot of controversy around the costs of actually running the Bitcoin network. Ethereum is, which is, by the way, probably most of you know it. Ethereum is the blockchain platform that almost all of the initial coin offerings that we're going to talk about shortly were run on. It was the first platform that allowed people to encode rules into their coin, smart contracts. And it's really, really cool if you're a hacker or a nerd. If you're an enterprise trying to use something that's reliable and scalable, it's a piece of junk. And they acknowledge that. They probably don't say it quite in those terms, and that's why they work for their marketing department, but it's a piece of junk. And there are protocols and platforms that are coming now that are newer, that are evolving. But there's one thing you've got to actually remember. The user experience is not there for blockchain. Using cryptocurrencies is still somewhat difficult if you're not a technical person. It's not a technology that's ready for prime time yet. I think it will be really soon. I think that the projections are probably right, but it isn't there. So that's something to bear in mind as well.
Thank you. We hear a lot from some like traditional businessmen. They say, "Oh, blockchain will not be disruptive to our technology. It is too expensive to run." What do you think of this misconception, and if there is any other misconception about blockchain that would on that?
Yes, I've heard many objections. Scalability, latency, lack of transparency in how the system operates. So some of these objections are actually true. I mean, the privacy issue is not resolved. Scalability is not resolved. Latency, if you compare to other transaction systems, are much quicker, more efficient. You probably don't need a blockchain for everything. But if you think of the internet, next year will be the 50th anniversary of two computers connecting in the West Coast in the US. That was the first time, the first node connecting two computers. And a few years later, it still looks very scarce, a very scarce network. And we've come a long way. That took 50 years. Now compare that with the blockchain. The first blockchain Bitcoin transaction was done at the beginning of 2009. It's not even 10 years. So it's normal. It's a fledgling technology that has to overcome many of those objections. None of them, I think, are unsurmountable. But obviously it needs to gain much more competitive advantage when it comes to usability, when it comes to mass adoption, because certainly I haven't seen yet a migrant transmitting some bitcoins to another country. We haven't seen many use cases, many prototypes, many tests, but real applications have yet to come for the most part.
So the first thing is, whenever I hear an incumbent business saying, "Oh, this technology isn't a threat to us," I love that, because that shows me a business that I can take down, be more nimble than, be faster than. And the thing with, there's actually a fantastic model, it's not mine, it's a guy called Peter Diamandis, who's one of the founders of Singularity University, talks about stages of disruption. And he says, the early stage technologies are deceptive, and people don't understand them, they're sort of hidden. And I think blockchains actually emerge out of the deceptive phase already. But like Thomas Watson, the founder of IBM, famously predicted that global demand for computers. Anyone know this? So the founder of IBM, how many computers did he predict global demand would be? Yeah, and McKinsey consultants are like that. So that's about right. And this is the guy who essentially invented business computing, right? So the lesson obviously is that very few people can think exponentially, and yet technology grows exponentially in capability, speed, spread, etc. And so what's happening, of course, with so many different exponential technologies, such as AI, such as machine learning, and nanotech, a bunch of robotics, a bunch of other things coming together, The pace of change is increasing so much that people who don't see disruption in their own industry are asleep at the wheel. And if I ever held shares in a company where I heard the CEO or the chairman say such and such technology is not a threat to our business model, I would short them immediately. Because every business, every sector is going to be disrupted by technology, whether it's blockchain or AI or robotics or what have you. It's just an inevitable factor of the business landscape. Now blockchain itself is a little bit flavor of the month, and you go to all these corporate conferences, and there's lots of corporate types who I like to make fun of standing around, sort of talking about how they're going to adopt this decentralized technology into their closed garden, central walls and trusts that you were talking about. It ain't going to happen that way. But anyone who isn't worried about this technology disrupting their industry isn't paying attention.
Yeah, I think it's a really interesting question. So firstly, on the technology misconception point, there's a lot of misconceptions around blockchain. I mean, blockchain is Bitcoin, no, it's just an application. On the technology point, so there's effectively three levers around speed, security, and scale. And speed is the size of your block, security is your consensus protocol, and scale is how many nodes you have. You can adjust those levers to make the technology actually viable in most settings, which was the thing that was really interesting around doing some of the research we did with some of our technical experts. So all the stuff around the energy consumption that comes with Bitcoin, that's because it's a specific set of choices around that makes it very difficult to scale, and that isn't what you need to make in many other settings. So to give an example, Estonia actually have they're incredibly digitally advanced, the government, and they use blockchain to secure their health records. Now they don't store all of their health records on a blockchain database, but they use a blockchain or distributed ledger system to verify who accessed the records, when did it happen, and keep a very thorough record of all of that, which is immutable. The second misconception I'll touch on is that blockchain is a truth machine. I think the great way to capture this is if you put garbage in, you're going to get garbage out. Like if I tell everybody that I own half of Sydney, I don't own half of Sydney, but I stick it on a blockchain, it says that on the blockchain, it's not true. So I think that's just one to bear in mind. And on the disruption potential, 90% of banks in North America, Australia, and Europe are experimenting with blockchain. 70 of them are in R3 consortia, which is looking at can you use a blockchain system to replace SWIFT, which is the way all interbank transactions are recorded. So companies are very live to this. I don't think it is flavor of the month, it's exciting and buzzy, but taking it very seriously, and whether that's in proof of concept or consortias. Like Toyota has got a blockchain consortium looking at the way you can get blockchain may enable the future of autonomous vehicles through the fact that you can have, anyway, I won't digress too much, but people are live to it.
Yeah, well, I totally agree. Even our stock exchange, ESX, replacing the chess system with the blockchain technology. And at MBAus as well, we just approved at MBAus the new course for blockchain and fintech, but we're waiting for the university. I'll be teaching this course, and you will see maybe those faces. I invite you as a speaker in the course. And if you want to know more as well, we're going to offer executive education course, hopefully early next year. So acknowledging the importance of the technology. The last question on blockchain before we move to ICO, what is the biggest risk associated with blockchain that we should warn investors and entrepreneurs about?
From a technology point of view, I think that one of the risks is that we are dealing with a fledgling technology. There are no general standards applicable to all the blockchains, so that becomes an issue. But as the technology evolves, I can see standards being developed, but that's not the case now. There's lots of experimentation with consensus protocols and discussions on which consensus protocol is the best for this and that. So we need to be aware that it's a technology that it's still in development. And from my legal sociology perspective, very quickly, I'm also very skeptical about everything being able to be put in a smart contract. We have decades of research on artificial intelligence and law, and researchers know how difficult it is to formalize a contract or legal clauses into code. Extremely difficult. you cannot capture all the nuances of legal negotiations into code. And therefore, to me, the claim that everything could be the object of a legal smart contract is very bold and very risky.
Yeah, I think you're 100% right, and the experience to date bears you out. So smart contracts can actually do a very limited number of things, and they're actually pretty dumb in terms of what they can. It's a good marketing term. But I'm going to take risk from a different perspective. I see the biggest risk, and I know we're sort of distinguishing blockchain from cryptocurrency, but I'll go back to my earlier point that cryptocurrency is the killer app. And say the biggest risk is actually knuckleheaded governments and regulators lumbering around this and stopping innovation or slowing innovation. And I think it's particularly a risk in a jurisdiction like Australia, which is very conservative, that yet again we lose technological edge because our regulators don't talk to each other, let alone the public, in a way that's actually comprehensible. So I think regulatory risk is a massive one. And I should say, I'm putting my money where my mouth is. We're moving our business to Canada and North America. And we're going to have all our IP based out of a special economic zone in Anguilla in the Caribbean. There's nothing dodgy about it, so don't look at it. But they do have zero corporate tax for the next. They do have zero corporate tax for the next 50 years. I'm just saying. So I think you're going to see real tension across regulatory jurisdictions, and that's already emerging. I mean, we've spent, I've spent way too much time on a plane, and we've spent a lot of time, effort, and money looking at jurisdictions. I've been in Malta a couple times. I've been in Lithuania. I've certainly looked at Estonia, which is doing amazing stuff. I haven't yet been to Anguilla and Cayman, but been in Switzerland. It's interesting. Switzerland got a really early lead out of Zug, and I would say they've now fallen quite behind. It can take 6 to 9 months to get registered, and it's become very bureaucratic. So I think they've lost the edge. Gibraltar's doing some interesting things, but everyone's worried about what's going to happen to Gibraltar post-Brexit, and it's also very, very small. So, I mean, we could do a whole hour, I think, just on regulatory, but to say that the technology, the use cases, the experiments in organizational governance and running and human ingenuity are outpacing regulators should probably not surprise anyone, but it is very apparent in crypto and blockchain. So I think that's a big risk.
I think I'd probably highlight 3, thinking about it from a business perspective. Like one, the create a hammer and then start looking for a nail risk. So if you don't start with really what are the fundamental pain points, and do you need blockchain to actually solve that, or can you just digitize your process, or can you use a traditional database, you end up creating these proof of concepts that then go nowhere. I think then you run into your second big risk, that you can get a lot of value from blockchain in a private permissioned instance, so basically where an individual entity would own it, so you can control it, so you're not a network in quite the same way. But the real value from blockchain comes when you have multiple parties on there able to transact with and interact with much greater ease. That relies on overcoming what we call the co-option paradox. So you need people who are inherently competitive to want to cooperate to get past that. And then you're talking human psychology, not just, can you get the technology stand up? The technology is not that complex, like you can build a blockchain in a day kind of thing. And I think so that's a really big risk. And then I think the third one touches a bit on Jeremy's point, the risk of unintended consequences. So blockchain can be held up as a really utopian vision for peer-to-peer, taking out all the big power from major entities and all of that. But you also get things where Bitcoin, I mean, a large number of people who are getting all the value from hashing Bitcoins at the moment, such as server farms in China and Russia that just have like supercomputers mining like crazy and then taking all of that value. So you get instances like that where regulation does need to keep pace. And ICOs, which we're about to talk on, is a bit of a kind of wild west of the cryptocurrency world at the moment. But
that's very comprehensive coverage. Thank you. Now we're going to move from the introduction about the technology itself. Now we're going to go to startups. And the first thing I would like to start with is just explain it in simple words, just like a few sentences. What is the initial coin offering?
let me explain it a bit in sociological terms. So the initial coin offerings is a model to crowdfund an initiative in the blockchain space. So you issue tokens, and these tokens are sold in a public sale, and then this will raise the necessary funds for the company to operate. To me, that's basically an ICO.
Yeah. So the cynic would say that the ICO phenomena we've seen from mid-2016 till sort of into this year may be the biggest single transfer of wealth from coin holders to equity holders in human history, without returning much value to those coin holders. And this is said, by the way, as somebody who ran a public token sale in January with Rishi, our COO, who's here. We raised $1 million US in a month using Telegram and Facebook on a white paper and a website, an idea. We had no tech, we had a company, but we had no operating business, miles from revenue. So in a sense, we're the poster child for what's great about ICOs and also what's not great about ICOs. What's great about it is that it is a way to raise money, and it can be quite quick and efficient, although these days the market is shifting very, very quickly. It has been largely unregulated, so there have been a lot of issues, and I think we've got a question about scams later, so I won't go too much into that. But it also has been an amazing way for some incredible organizations, from Ethereum to Bancor to hundreds and hundreds of others, to raise a heck of a lot of money really quickly without giving away any equity and without taking on debt. So it's a new fundraising mechanism. It is for the public, and it's, as we said, it's been done in a largely unregulated way. Now that's changing really fast. So we're actually planning for what's called an RCO or an STO, so a regulated coin offering or a security token offering, which means we are going to, first of all, list our company on the Toronto Stock Exchange Venture Board, so we'll have all the scrutiny of a regulated listed company with auditing, etc. And we're then going to do what they call an S1 filing with the Security Exchange Commission in America, which is basically the same thing you do if you're going to list on NASDAQ or the New York Stock Exchange. It's like a 140-page perspective, lawyers all over you for months. Really like the entrepreneur in me goes, oh! But, and why are we doing this? It's really, really simple, if I may for a second. So ICOs have generated a market that, depending on what day you look at it over the last few weeks, has been valued at between 200 billion and 260 billion US dollars overall market cap, which, I mean, yeah, that's a lot of money for me. That's probably a lot of money for most of you. And it's a fair bit of wealth. I mean, at its peak, it was about $780 billion back in late December, early January. And so that's a lot of money to have been generated, unregulated, crowd-funded, largely through tech-driven events in a very short space of time. But the comparison is the global regulated securities market is, depending on how you measure it, somewhere around 800 trillion in value. Okay? So 200 billion, 250 billion is a big number, but it is absolutely inconsequential compared to the global equities, bonds, and derivatives markets. And so my hypothesis, and it's not just my hypothesis, but certainly the hypothesis we're working on, is that the market will shift into the regulated space for the very simple reason that the institutions that control those hundreds of trillions of dollars can basically only invest in securities. Right? There's no category in their investment mandate to invest in something called a utility, which is what all the ICOs, almost all the ICOs to date have been. So that space is also shifting very quickly, and obviously we're hoping to be at the front of that wave, but that's the logic of it.
So very comprehensive introductions, but I might just build on what Martis was saying. So if you think about Airbnb, for example, when it was going to market originally, the difference you get with an ICO is that you could buy tokens in Airbnb, which would be the way in which you would then pay to go stay in a house, and those tokens would increase in value what you purchase as Airbnb as an entity was used more and increased in value. So what it gives people is an opportunity to interact with the platform use a platform by using those tokens, but actually get a stake in the potential value and growth that business is going to have. And that's why it's quite exciting, because you can structure it in different ways, but you're allowing people to be part of the growth of that business and get value as the business increases in value. The regulation point's really interesting. So the SEC has recently started to, the Securities and Exchange Commission in the US has recently started to regulate the ICO space. And there's a US company called Overstock. I don't know if you guys have heard of it. They sell furniture. Like, it's a furniture marketplace. Their CEO is doing this massive pivot into ICOs, and they have a subsidiary called T0, which is totally focused on blockchain. And they're part of a joint venture that wants to be the first alternative trading system, because the challenge that you have with ICOs at the moment compared to other securities is that I can't swap them with somebody else. So I bought a whole bunch of Airbnb tokens. There isn't a regulated or easy system for me to sell that on or swap the asset with somebody else who bought tokens somewhere else. So that is part of what is being worked on to make it truly malleable and liquid as an asset.
That's very good comprehensive coverage. I will add one more thing, is the ICO is related to an ecosystem where the entrepreneur startup like Jeremy will create the project and at the same time could secure demand. So you have the demand by selling the token. This is potential users of the system. So you have a completely new setup. We don't have this type of setup with our traditional way of venture capital setup. So this is what
Can I jump in on that?
Crowdfunding is a bit of
Yeah. So can I just jump in very quickly?
Sure.
So that is the theory, and as you say, crowdfunding. I mean, Kickstarter and other things are raising billions of dollars. In fact, I think I read that crowdfunding itself has raised more money for startups than venture capital in the last couple of years. So there are other models other than ICO. The challenge of the ICO model, so you're 100% right? So they were originally set up as the users of the platform who were going to get utility or usefulness out of these tokens would buy them. And the other thing we haven't mentioned is a thing called token economics, right? So that an ecosystem would be set up that there would be growing demand for the tokens because you'd have more users with more things they can do with them, wanting to do more transactions, so more and more people would want them. So you'd have growing demand and fixed supply. Okay, now hopefully everyone in this room has done enough economics to know that should lead to rising price. But what you're seeing in practice is that you're seeing the coin investors being very distinct from the coin users. And there's actually a massive disconnect between the people who are buying into the ICOs and wanting to get their Lambos and shoot to the moon. And there's a lot of sort of juvenile nonsense in it, as opposed to the actual token users who the coin is designed to give utility to. And there's actually often a massive chasm between when the ICO finishes, there's all this hype, they've raised all this money, the coin gets listed on a couple of the exchanges, because there obviously are very liquid exchanges, they're just completely unregulated, largely run by crooks. I didn't say that. You're not recording this. They're not crooks, they're wonderful people who we'd love to list on that. But there have been massive problems with the exchanges. In fact, anytime you've heard of thefts of coins, it's not because there's been a failure of the cryptography in the blockchain setup. It's because the exchanges have been run by people who don't really know what they're doing, and the coins have been stolen out of the exchanges almost always. So yes, you're right. In theory, it's a really cool crowdfunding mechanism. In practice, it's not quite turning out that way. And this is one of the challenges that I think is pushing it towards a more regulated environment, because those traders are doing all kinds of things like wash trading and trading amongst themselves and front running that if you did on a regulated market, you go to jail. Right? And they happen all the time on the crypto exchanges. So.
Just a quick one. I think that's the challenge of a new discipline, which is crypto economics. It's not just about designing the appropriate cryptographics for this, but also redesigning the incentive structure, which becomes very completely entangled because of these competing interests.
And it's hard. I mean, I should say, like all entrepreneurs, I've done a fair bit of consulting work, as a startup's getting going, and a lot of that I've been doing tokenomics design. And it's really hard to actually think about designing a self-contained economic system with its own currency that is genuinely going to generate growing demand from an identified user base. And it's not actually a trivial task. So, and a lot of people do it very badly.
I guess the one thing to add on token economics is the thing that's quite exciting about it is it enables fractional ownership. So you can take an asset like a Monet, which most people can't own, and you can buy tokens in a share of that asset, whether it's a Monet or whatever it is. And Jeremy can talk to us a lot more. It's basically what this business does.
How many hours do we have?
How are we doing? Okay. I think we need to quicker. Maybe just time.
Is that
this part, maybe. Reflect on the advantage and disadvantage of the ICOs. You can talk about it if you summarize them in a few sentences.
Well, one of the advantages I think was that whoever launches an ICO initially, they didn't have to be a regulated company.
Which is quite few. Fundraise on coin schedule, for example, 10 billion. So is it quite large? And if we look at countries, for example, US, UK own roughly 20% of the market share. Switzerland around 9%. Based on in ICO coin, Australia only 1%. So we have, it's apparent the regulation is impacting the startup. And if we look at industries, we have finance 13%, communication 20% in terms of market share, infrastructure 14%, payment system 5%, gaming 6%. So there is a quite development in the market. In your experience, when you take share returns, what are the most innovation uses you've seen in blockchain?
Generally.
Yes.
Okay. From my perspective, as a political scientist, I would say that there are plenty of interesting stuff going on in the democracy, in the digital democracy space. Let me disclose, I was a member of the advisory board pre-ICO of one of these startups, Horizon State, which is a platform for blockchain-based voting systems. Australia is quite innovative in that space. There are a couple of movements that somehow are political parties now that use the blockchain to collect the input from their constituencies. One is My Vote, the other is Flux Vote. These initiatives are expanding also to other countries, but they were initially designed in Australia. So in the digital democracy space, I've seen a lot of interesting developments, and we'll see more probably.
Not your currency.
I was going to say the ability to monetize, unmined metal and trade metals globally is pretty freaking interesting. But I won't talk about that. Actually, what I say with a little bit of sadness is probably the most innovative thing I've seen on blockchain is a thing called CryptoKitties. Anyone seen CryptoKitties? And I know why you're laughing, because it's a completely brain-dead, moronic, idiotic application. But it's really, really innovative. And the reason it's innovative is because it uses a thing called non-fungible tokens. So any economist in the room know what fungibility means? It's just money. It means every unit is the same, right? So every time I give you a $5 bill, it's the same as any other $5 bill. Bitcoin is fungible, because any Bitcoin is exactly the same as any other. CryptoKitties, as I said, whilst it's a bit of a brain-dead application, you get these digital cats that you can collect, and they're all different. And they actually breed and have genetics. It's a brain-dead, idiotic application unless you're a 14-year-old Chinese girl, because they seem to go crazy for it. But the thing that's really interesting about it is this idea of non-fungible tokens, right? So, and in fact, Ethereum brought out a whole standard called ERC 721, for defining non-fungible tokens. And a non-fungible token is something that you can trade on the blockchain with all the advantages of a normal cryptocurrency, but each thing is unique. And so hopefully there will be somewhat better use cases than CryptoKitties for non-fungible tokens. But you have to remember, it actually broke Ethereum, right? Because so much activity was going on in like December, January past, that it was run over the Ethereum public blockchain, that Ethereum actually crashed. Okay, so you're all laughing, but I bet you if we had an honor show of hands, somebody in the room owns a CryptoKitty. Come on. No? Okay, that's really interesting. Some of these things have sold for hundreds of thousands of dollars, by the way. So, you know, for an entrepreneur looking at something that costs nothing to create, it's also kind of interesting. But so I do think non-fungible tokens are really interesting, and CryptoKitties. And I think, yeah, as you mentioned, monetizing illiquid assets, whether it's fine art, real estate, data, metal, etc., is also going to be a massive application. So those are a couple. I'm trying to be quick.
This is a fun question. So I'm going to have three, if I can. Quickly. Ledger, it's an Australian startup. It raised 34 million on its ICO, and it's a peer-to-peer marketplace for trading electricity, where people can generate and trade electricity themselves. I think that's pretty cool, and it's homegrown. There's also some stuff that's really interesting around supply chains and cold chains for organs. So organ donation, you have to keep it at below a certain temperature, otherwise the organ's defunct. And so they're using, there's a couple of startups in the States that are using blockchain-based systems plus IoT sensors, so they keep a immutable record of exactly what temperature the organs are at every stage during its transfer cycle. So you could automate the fact and regulate the fact that, okay, you know this organ's good to go. So that's, I think, pretty
Impressive.
That's cool.
yeah. And then the last one, which I think is awesome, is the World Food Organization did a project called, was it blockchain? I can't remember what it's called. But anyway, what they did is they were looking at the way in which you can transfer aid to refugees, so Syrian refugees in Jordan, using blockchain to eliminate all of the foreign exchange fees and like currency and money transfer fees through banks. So they built blockchain and they transferred, I think, about 1.4 million of aid to Syrian refugees in these Jordanian refugee camps to these 5 core supermarkets. Now the key thing you've got to solve for there as well is the fact that these people often don't have documentation evidencing who they are. So there was done blockchain-based money transfer, which was then on these kind of vouchers that would go into the supermarket, which then used iris scanners to scan to verify their identity. Now the amazing thing about this story is that they were already using the iris scanners in the supermarkets to distribute the aid because they didn't have any other way of validating the ID. But what the blockchain did is it took out 92% of the cost of the money transfer. And when you're talking about 1.4 million, like those 3% charges are quite significant. Just it's the World Food, the UN World Food Organization. It's called like something like blockchain builds, but that's not exactly it. I'll look it up and get back to you.
I think it's in collaboration with the United Nations
Yes.
High Office for the refugees.
I can send you an article on it.
A quick one on that. We had precisely yesterday an event at RMIT on blockchain and philanthropic organizations, and there are projects that look really amazing. Oxfam and other large organizations building on the blockchain to make the supply chain for international aid more efficient and transparent, so that organizations can focus on what they should be doing, which is the management of the aid, rather than spending a lot of transaction costs in the management of that aid.
Very good, thank you. That's amazing. I'm going to cut some questions for the interest of time and turning to Jeremy. I want you to tell us in a few minutes your experience in terms of choosing the project, why you chose, for example, the mining, the gold, and how did you choose your team? You talked a bit about listing and where you're going to go with the regulatory aspect of it. It's just some idea for startup, if they're going to start their own ICO,
Sure.
what they have to pay attention to.
Okay, so I'm going to summarize about 2 years of my life into hopefully about 2 minutes. So I mentioned I worked for a gold refiner, and when the ATO essentially shut down small refining in this country, I went and started working for some of my mining clients to help raise capital. And raising capital for small cap listed pre-production mining projects is really hard. And if they're not listed, add about 7 more releases. It's just almost impossible to get funding. And when you do, the funders just take an enormous chunk of what you're doing. So I was working away, traveling, talking at conferences, trying to find investors, and watching this whole ICO phenomena come up, because I'm basically a tech nerd and a bit of a geek at heart. So I was watching all of this happen and thought there's got to be a way to bring these together. So I would say, the classic story, it actually evolved out of seeing a real problem for a real group of businesses and saying, could this new approach solve it? Could we use the crowdfunding nature and the global nature of ICOs to fund mines? Now, the concept has evolved, of course, as we've learned more and grown, and we've been quite nimble in how we're trying to implement it. My team, my comms guy, I've known for about 30 years, lives in Poland, and we started talking about this at his brother's wedding 2 years ago, and he's kind of helped me co-create the idea. My COO, who's in the room, basically was introduced to me through the blockchain network. We started talking. I took him to a mining conference, and he said, "This is amazing. I want to work with you. I know you don't have any money, but I'll just sort of hang around until you do." And and I have to say, and I don't mind saying in front of him, he's awesome. He hasn't got any equity yet, but when we list, he will, and he does have coins, and he was instrumental in us raising $1 million at the start of the year, and really, and he's just awesome. But he got into the team by being around and being enthusiastic and asking lots of great questions, and frankly, that's how I've gotten into a lot of entrepreneurial projects as well, some to my chagrin and some with great success, but showing up is a lot to do with it. And our CTO, I actually knew at high school, and when I was in the refinery, he was running a bullion dealership, even though he's a cybersecurity expert. He was doing some research into cybersecurity and money laundering and figured out that most of the bullion dealers in Australia didn't really do a very good job, so he started one and grew it and sold it, and is now working for us, looking at the technology and the trading. So it's been, it certainly hasn't been the classic, run an assessment center, do all the supplementary testing. It's basically, you find great people and you sell them an awesome vision and hopefully have some money to pay them at some point.
Did you source out like some outside fund before you went to the ICO stage?
So this pre-ICO we did was our seed funding. So I'd probably put some money of my own in and done some travel. I went to China with somebody we were partnering with in December, did a road show, and we agreed that she was going to raise $1 million in China. I was going to raise $1 million out of China. We did our bit. She apparently did her bit, although it's yet to show up in our bank account. We're no longer partners. Feces occurs. That's polite for shit happens, none of you laugh. And you are allowed to laugh at me, I'm genuinely fine. And that sort of seeded us, and we're now doing a round that will hopefully fund us through the listing and the SEC process and what have you.
So given I'm also involved in designing the ICO for the project, so what we're struggling with, for example, how would we attract the investor before we design some form of proof of concept? So how did you work on that?
We went brass balls to the wall and looked really confident and had a great white paper. and frankly, that's getting harder and harder to do. It was also a window of time. Yeah. So I'd say sort of September, July last year till February, March this year. Obviously, there was a massive run-up in the values of the cryptocurrencies that were traded. There were a huge number of ICOs. Unfortunately, many of them have failed to materialize into the community that they'd advertised. Some were outright scams and just people took the money and took off. But a lot of them were trying very hard to do good things. But they, for a company, for a startup to suddenly have 20 or 30 or $50 million is actually quite a dangerous thing. If they haven't built the organization around it, if they don't have the people with the experience to deploy it, much as we would in some ways love to have gone and done that in April or May, it's not actually a great thing for an organization to do. And I think the short answer is you've probably got to raise some traditional equity or use some kind of a convertible instrument or a SAFT, sale of future tokens agreement, to get the seed funding to build a minimum viable product. I think in this market that's critically important, certainly so as we're moving towards a Canadian listing, we'll have an MVP ready, we'll have some revenue on it. It won't be what we're ultimately hoping to build, but I think the days of a great idea, a white paper and a cool website, and let's go raise $50 million, for better or worse, might be behind us. And I keep saying, even though we didn't manage to grab $50 million out of it, which I'm a bit disappointed about, it's not entirely a bad thing, because I'm not sure it's a very efficient funding mechanism.
Right, that's a new mystery novel general.
Given what you know now, what would you change?
Nothing, because it's gotten us to where we are. It's probably taken longer than we hoped. I spent more time away from my family than I would have liked to. But it was really important to be at the conferences, to be in the different jurisdictions, to talk to the regulators in Malta, in Lithuania, in the US, to be sort of connected with all these people. Even the China experience. I mean, I was there as they were banning ICOs in September, and my partner was going, "Oh no, it's fine. We'll find other ways." And she did. I mean, she would sell envelopes with 12-word seeds to people. And that was the way she sold coins, right? And she also sold equity in this company and then gave people the coins. So she wasn't doing an ICO. All these kind of interesting structures to get around regulation. Look, maybe we would have gotten a product built faster. I think if I look back in hindsight, we're probably now about 6 weeks from a really basic product. And so we'll have something and we'll have some revenue, even though it's not, as I said, what we're ultimately fully trying to build. It'll be a start. If I had my time again, I probably would have gotten that done in January or February. I think, it just changes the investor conversation when you do have something that somebody's prepared to pay for. So that would probably be my biggest one. And I would have cloned 2 or 3 Richies and more of them, because it's just awesome. but no, in all seriousness, I would have had a minimum product generating revenue faster. That's kind of the key learning.
Great, thank you very much. I will turn now to Marta because it's regulation questions. We discussed briefly regulations. Countries we know are taking different approach in regulating the ICO market. For example, Switzerland more relaxed in comparison to other countries. China is taking the other extreme and put bans on Bitcoin payment. The question to Marta, what is the current approach taken in Australia?
I think it's somewhere, you will correct me, Jeremy, but I think it's somewhere in between. It's basically telling people, let's try to play by the rules. And the rules are the Corporation Act and the Consumer Law. And if the tokens you guys are issuing are financial assets, then you should comply with the Corporation Act. And that's probably the case in many of the ICOs that we've seen. So I guess the best approach is to take a precautionary approach and consider that complying with existing rules is the better way to go. Maybe it's also interesting to create, and Europe has also some experiences in that, in creating the regulatory sandboxes for people to experiment with these new fintech products in general. And I think it's also a healthy approach that I would encourage Australia to be more open to.
Can I jump in on that very quickly? Because there's actually 3 pillars of regulation that are required for a successful cryptocurrency. So corporations law is one, so proper distributed ledger crypto regulation. In Australia, that's actually not bad. It's taking a reasonably open approach. The other 2 are banking and taxation. On banking, there's no regulatory approach, and Australian banks are arbitrarily shutting down bank accounts for cryptocurrency-based businesses and for even traders who are bringing significant funds in and out of cryptocurrency exchanges. So from a banking perspective, Australia is in the absolute desert, along with most of the rest of the world. From a taxation perspective, the ATO, as far as I know, hasn't yet issued definitive guidelines, but they're basically saying we'll tax everything at the highest possible rate, which is unfortunately the ATO's traditional approach, and it will make Australia a very unattractive jurisdiction. So ASIC probably 6 or 7 out of 10, banking 0 out of 10 in the ATO, it's a quantum state. Who the hell knows what the wave will collapse to? But probably closer to zero than any plus or minus 5%. And I mean, let me just compare that really quickly. So the special economic zone that some of my advisory colleagues are setting up, that I've had some involvement with in Anguilla, will have zero corporate tax and personal tax for 50 years. Proper crypto and fiat banking regulation with correspondent banks. And one of the big problems, for example, with Malta is that they've regulated that the local banks have to accept fiat and crypto transactions, but most of them don't have correspondent banking relationships with banks that will take money out of Malta to anywhere else if it's come from crypto. And the problem is, I actually heard the head of the European Central Bank's regulatory division say they're not even interested in considering cryptocurrency, and this was the end of January. So yes, Europe's doing some good things in a regulatory sense, but from a banking perspective, they're also a massive fail. And from a tax perspective, I mean, obviously zero tax is nice and not very sustainable for a whole country, but there's got to be some global competitiveness before Australia's really going to show.
And I just also wonder whether it's helpful to distinguish here between regulation around cryptocurrency and regulation around blockchain. So with blockchain technology, I think most regulators are actually taking quite a technologically neutral approach. So to Marta's point, play with the rules, you can. Some being a bit more willing to experiment than others, but you can see that contrast in the example of China. So China having a stance on cryptocurrencies, but the Hong Kong Monetary Authority is this month, September, yes, launching a blockchain-enabled system with 20 banks, which to enable interbank transfers. And that's the first time you see a regulator being part of the solution itself, which is pretty interesting. So I think in general what you're seeing is the move to the SEC recognizing ICOs as an asset, like they're embracing the technology and bringing it within the scope of regulation, and then exactly how that plays out, somewhat TBC. And then the last point I made was then also the regulation question and the standards question. So to Marta's point again, the standards question is vital here because you need interoperability between the systems, and that's where you get the value. And Standards Australia is actually taking a bit of a lead on this, and they're trying to do the first cut of what some of the for the International Standards Organization, what the standards around blockchain should be.
I have many other questions, but unfortunately I have to cut them down on performance, which is really interesting. But the last question is, where do you see the future of ICO market in terms of growth, opportunity, and global acceptance? And this question will end basically our discussion tomorrow.
It's very difficult. I can't separate this question from the future of the blockchain technology itself. And to me, I see this future very much connected to in convergence with basically artificial intelligence and robotics in particular, and the Internet of Things. So yesterday, I think Walmart announced that they will be launching an army of robots that will be controlled on a blockchain-based platform. So I'm seeing this type of technology convergence and integration growing. And that will probably take us to uses of blockchain and consequently companies offering services we have not yet imagined. And that's why I said at the beginning that to me this is a transformational technology, not just a cryptocurrency thing or a ledger. It will literally bring us to new services that we are not yet imagining.
So I think purely as a capital raising mechanism, the ICO, well, I mean, forgive me if I'm repeating myself, we're going to raise $100 million through an institutional placement of a registered security token. And we think that that is the future of where most of the ICOs will go. It will become well regulated, lots more transparency. You'll have to be a real business with a real offering already. And the funds will be used for growth and, in our case, liquidity on an exchange, not to build a business from scratch. I think it's moving very much that way. And I think it will continue to grow. I think there'll be proper valuation models. I mean, there's good models at the moment for valuing equity or even obviously debt instruments. there aren't really good models for company valuation based on an ICO because it just doesn't seem to be correlated. Obviously, listed companies that have made coins and started selling them have gotten a temporary bump in their share price, but there aren't really good valuation models yet around how enterprise value is impacted by tokenomics and token growth, as opposed to equity growth or debt at this stage. So I think it's got a long way to run. I think once it becomes a securitized asset, you'll have analysts covering it, you'll have proper financial analysis, you'll have a derivatives market, and it will, as I said before, it will grow to become a new and massively valuable asset class, and you will see much more professional, institutional focused coin sales.
You mentioned an interesting thing about the potential analysts. If you look and check ICO bench, they have something rating, and they try to limit this financial analyst. And they have also rating for the ICO, and they have rating for the group. They call it KYC.
Yeah, I don't want to burst your bubble, but you pay for those. And look, you pay for a Standard & Poor's to rate you as well, so yeah, maybe it's not such a different model. But look, there are attempts to start it, which is great, and it shows a maturing of the space in a really rapid time. I mean, yes, Bitcoin's been around since '09, but really the space hasn't taken the public imagination much before about 2013 or 14. So yeah, that's really, really recent. It's evolving super rapidly. In spite of what I say about regulators, they are actually moving relatively quickly for regulators, and the space will continue to professionalize and